This is a chart showing how quickly SoFi's platform is growing, but this is a chart of their stock price over the past few months. As you can see, it's down a lot. And when I see a chart like this for a company that's growing quickly and making more money than ever, it tells me there could be a huge opportunity to get this fast-growing fintech stock on sale. Maybe even a multi-bagger for a long-term investor focused on holding for 5 to 10 years. So I've spent the last couple months going deep on SoFi, and it's kind of fun acting like a detective, sorting out the hype and the FUD from the really juicy tidbits that can hint at what's actually happening behind closed doors at SoFi. This is how you get in and then predict the next rise in SoFi's stock price before it happens. So I had two goals when looking at this stock. First was to understand the three main drivers behind SoFi's business, and more importantly, how they will work together to grow the company and thus the stock. And second, to use that knowledge to predict what buying 2,000 shares in SoFi today will be worth 5 years from now. So to solve that first goal of understanding SoFi's business and predict their future stock price, we need to start in SoFi's past. Because today, many people think of SoFi as an investing app, or maybe as the bank that sponsors SoFi Stadium in LA. But it's helpful to see how they got to that point to help understand the decisions that they're making now. So let's start at the beginning. 2011, Stanford Business School. The economy is still in a slump from the 2008 financial crisis, when four kind of unlikely personalities came together to start a social-based lending company. The idea started as sort of a social experiment combined with a business. Instead of students going to the big banks for a student loan, they could instead borrow money from alumni and friends of the university at a lower rate. They were kind of sticking it to the big banks at a time when Occupy Wall Street was all over the headlines. And this is still a core part of SoFi's identity, that they're the little upstart trying to fix a system ruined by the much bigger Wall Street banks. But SoFi quickly outgrew those social experiment roots, expanding to offer student loans across the country. And as the business became more mature, this formed the first core component of the modern SoFi, which persists today, a massively profitable, consistently growing lending business. This is where SoFi started to make the real money, and it's the biggest driver of the company's revenue today. But even with this first core cash cow in place, the company had another problem. SoFi had been growing so quickly in student loans that they soon owned the majority of the private student loan refinancing market. And with that growth came some serious growing pains within the company.
Well, SoFi is the latest high-profile Silicon Valley company to face accusations of an unrestrained workplace culture. Earlier this month, CEO Mike Cagney stepped down amid harassment accusations.
SoFi's CEO, one of its founders, was ousted in 2017 amid allegations of harassment and a toxic workplace culture. And it became clear at this time that the board of the company needed to do something to grow the company beyond its college origins. Now, it's not 100% clear what happened in the following months, but we do know that most of the original founders ended up leaving the company around this time. But now it's 2018. You have a company worth $4 billion that needs to course correct while also filling in the huge power vacuum at the top. You need to somehow find someone who has tons of leadership experience, knows a lot about banking, has a strong tech startup background, and who is amazing at marketing and communications. But how on earth could they find someone who checks all those boxes? They found someone.
Anthony Noto.
Anthony Noto?
Anthony Noto.
SoFi CEO Anthony Noto.
Anthony Noto. Okay, brief side note, this guy is legit. Former chief operating officer of Twitter, joined Goldman Sachs out of college and was a partner in like 5 years. Later led their communications and media research team. He apparently graduated from Army Ranger School. Oh, and he was the chief financial officer of the NFL. So check, check, check. Check. Noto was picked to take over the company. He was, and still is, brought in to transform SoFi from a startup to a mature company. And how does all this tie back with SoFi's stock price today and in 5 years? We're getting there, because this is where it gets good. In 2018, Noto goes to work reshaping the very fabric of SoFi. First, lending gets expanded outside of student loans and into areas like mortgages and personal loans. These companies grew massive under Noto. But second, he introduced a whole new strategy which they called the Financial Services Productivity Loop. This is going to become very important when we start to predict SoFi's future stock price. Now, instead of only focusing on selling loans, they would build a whole suite of products that make their customers' lives easier. They kickstarted this by launching their second business within a business, or what they call their financial services segment, which started out with the SoFi mobile app. And things kind of took off. In the late 2010s, you had a bunch of investing apps blowing up. Robinhood was the best known of the bunch, but there was a lot of competition. And SoFi dove headfirst into this crowded market. And even in the comments below this video, you'll probably see someone mentioning how one investing app or another is better than SoFi. But I think that misses the point of what SoFi was doing here. The SoFi app originally launched with two main sections, SoFi Money and SoFi Invest, for money management and buying stocks. But their goal was never to build the best investing app or even the best bank account. What made them unique wasn't the features they had in the app, it was how the app actually made money, or rather how it didn't make money, at least at first. And here's where we start to get some of the decisions that are directly impacting SoFi's business to this day. There's this great chart that SoFi likes to show during their earnings call. It's made up of two inverted triangles stacked on top of one another. The top side represents their financial services, like their app, and the bottom is their lending business. Now, when Noto took over, SoFi's business used to look something like this, with the entire company basically relying on student loan customers to feed the business. But now, as the company launched new features for their app and new financial services products like SoFi Credit Card, those brought new customers into the SoFi ecosystem. So even though one product might not be enough to cover the cost of getting a customer, customers tend to start with one product and then expand to using more of them. It's like an inverted pyramid. Then you stack that entire pyramid on top of a second pyramid of loans, and you create a money-making machine that can spend a ton of money attracting customers with great services and then make all the money back up on the back end. It's hard to compete with a business that doesn't need to make money immediately, and it's a strategy that's launched some massive names in the past. So we're now getting close to SoFi's final flywheel being built. The flywheel that will drive how much money our 2,000 shares in SoFi can ultimately make us. But first, Noto needed to close the gap between this new fintech direction and the company's more banking-focused past. In 2020, Noto made the then controversial decision to spend $1.2 billion, which was like 10% of the entire company at the time, buying the payment software company Galileo. And then in 2022, they acquired Technisys, a cloud banking platform, for a similar amount. But the company was now public after a SPAC merger with Chamath Palihapitiya, who's a controversial figure in SoFi's past and who is mostly responsible for SoFi still getting labeled as a meme stock to this day. I've talked about how annoying I find that term when it's applied to SoFi a bunch of times in my Fintech Circle live streams. But now, as a public company, the pressure was on for SoFi to perform. And Noto used these two massive acquisitions to create a third piece of their business that they called their technology platform. So this is 2020, and this is a really big deal because it totally changes the business that SoFi is in. Yes, they still had a consumer-focused side, but they were now also becoming a B2B business, a company that sells banking as a service to other fintechs. This had some interesting effects. For example, some of their competitors were now their new customers. This puts in place the third part of SoFi's plan to become the AWS of fintech, and this will form the third part of the valuation that we'll be estimating for those 2,000 shares. But before we get to that valuation, this new strategy is really important to understand for long-term investors. So I'll use the analogy that Noto likes to use. In the same way Amazon built a giant system to power their own e-commerce website, SoFi is building the fintech backbone to support their business. And then, like Amazon started selling their service as Amazon Web Services, AWS, SoFi is building their platform so that new fintech businesses can be spun up as easy as it is to set up a new website. That technology platform will then connect the financial services productivity loop together, closing the circuit in a way, which is going to form the core of our prediction for our 2,000 SoFi shares. So now that SoFi has the loop in place, it can start to spin up the engine of the business. When a customer signs up for a credit card or the SoFi app, that then funnels new customers into more valuable areas like lending. And if a customer signs up for a loan, they can get embedded deeper into the SoFi ecosystem through financial services, which is all enabled by SoFi's technology platform, which gets data fed back into it to make the platform better and better. So the reason we went through this explanation is because when you buy 2,000 shares in SoFi, you're really buying into this loop. But how much is that worth? And how can we use this understanding of the business to make a return as investors? Well, Warren Buffett says a business is only as valuable as the cash it produces. So let's start there. So when investing, we want to focus on a company's business, not just their stock price. So we'll start by seeing how much each separate business segment is worth. And then we can estimate how much the productivity loop adds on to that total when taken together. And for anyone who's not into the numbers, this is super important because I think Wall Street is missing something here. So if we copy Warren Buffett and look at this like we're owners of the company, owning 2,000 shares means you own, this is actually true, 0.0002% of the company. So let's see how much profit each segment would pay us if SoFi decided to stop reinvesting and just give us all the cash. And yes, we're intentionally ignoring the finer details here because we're looking at this like engineers. Simplify and then add variables later. So in lending, we can see from SoFi's latest earnings that they made $207 million in their most recent quarter. I'll show the math just for this first one. I know some people hate math, but it's just multiplication and we're putting real money into this stock. But for the SoFi investors, if we just forecast out their lending earnings for the entire year, it would be around $830 million for 4 quarters. It's just rough numbers, but that means our 0.0002% of the company pays us $1,700 per year in our theoretical math world here. Okay, now I'll just do the same calculations for the other segments and just show you the results. For financial services, we get $75 per year, and for tech platform, we get $60 per year. So if you bought 2,000 shares in the company today, you're getting paid $1,800 in profit per year. But wait a second, you're paying over $13,000 for those shares at the current stock price. So by combining these two numbers, we can create our own valuation. We'll call it our price to contribution profit ratio, PCP for short. Although we may need to work on that name. Well, our PCP comes out to 7.22. Now, this is a custom valuation metric showing the value per segment. Now, you gotta be careful here, because you can't compare that to other businesses as it's going to be lower than the PE ratio, since it excludes expenses from running the overall business. But here's why it's useful. We can use this metric to compare SoFi today to the SoFi of 5 years from now, and see what happens if we just let that financial services productivity loop continue to run for another 5 years. And this is where things get interesting. So what would 2,000 shares in the stock be worth in 5 years? Well, lending is probably going to keep growing, bolstered by the continued influx of customers from financial services, and tech platform is going to grow as Technisys finally finishes being integrated into SoFi's banking as a service business. So let's put some rough numbers behind it. And don't worry, I'll recap what we did once we fill this out. So lending will get some bounce back after recovering from the drop that it saw with student loans in recent years. And it's going to get a boost from financial services driving new customers onto the platform. There's that diagram again. So for the past 2 years, SoFi's been growing lending at 24% year over year. So let's be conservative in our forecast and say they'll only grow 20% per year going forward. That puts the theoretical cash that lending pays us each year at $4,200 5 years from now. Now financial services will continue to launch new products and cross-sell more and more existing products. Growth has been a lot less consistent in this segment, but their costs are starting to come down relative to revenue. So I think a 40% growth rate in profit per year is totally possible here, putting financial services at $400 in 5 years. Then lastly, we have the technology platform, which could be an absolute monster in 5 years. This one is the hardest to estimate since it's the newest one, but I think if we combine its direct profit with the extra profit it will drive to the other segments, a 5x in technology seems pretty reasonable, for a total of $4,800 for this segment. It's rough numbers, but all my assumptions are laid out in this video. Feel free to tweak some of the numbers and see what you get if, say, financial services only grew 25% per year. So now if we assume SoFi's PCP stays strong at 7.22, we can rearrange the equation to see what SoFi's value would be, which means our 2,000 shares in SoFi would be worth 7.22 times 4,800, which is $34,500, a nearly 3x from where they are today. I'll have a post on my Instagram laying out these assumptions and calculations along with the daily stock content that I've been putting out every day there. But if you want to see what can boost the stock price today, here are 7 more secrets of SoFi's stock that the market is completely missing at SoFi's current stock price.